What is a mutual fund? What's the difference between a mutual fund, an index fund, and ETF? These terms are sometimes used interchangeably, but they're not quite the same. They are similar, each offers its own pros and cons. In this video, we'll go ahead and define them together, clear up any misconceptions people have about them, and help you decide which you would like to invest in. Mutual funds are an investment strategy that allows you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities that may be difficult to recreate on your own. It does not require a bunch of money to get started investing, and it saves the individual investor, you, hours upon hours of research it would take to research individual stocks. The average mutual fund holds over hundreds of securities, some even over thousands, which means a mutual fund shareholder gains diversification at a low price. Consider if you are an investor that purchased an individual stock, let's say Apple. You're at risk to lose a great deal of money if the company experiences a bad quarter or a bad turn of events. On the other hand, if you buy shares of a mutual fund, you will own some Apple stock. When Apple has a bad quarter, you would lose significantly less because Apple is only a small portion of that mutual fund's portfolio. You're not putting all your eggs in one basket. You can earn a return from a mutual fund in 3 ways. 1. Income earned on dividends held in a mutual fund or interest on bonds held in the mutual fund. A fund pays out nearly all its income it makes throughout the year in the form of distribution to you, the shareholder. The fund will give you a choice to do whatever you want with the distribution today, or you can reinvest that distribution back into the mutual fund. 2. The fund sells shares that have increased in price, meaning the fund has had a capital gain. These are passed along to you, the fund holder, as a distribution. 3. The funds increase in price and are not sold and still held by the fund. Now you can decide if you want to sell the mutual fund shares yourself for a profit. Mutual funds are divided into several categories, representing the type of securities they invest in, their objectives, and the type of returns that they seek. You can invest in stock or equity funds, bond or fixed income funds, or sector-specific funds such as technology, healthcare, clean energy, or others. There are even subcategories for stock or equity funds, such as small cap, mid cap, or large cap, referring to the size of the company you're investing in. Small cap generally refers to companies with a market cap between $300 million and $2 billion. Mid cap for companies between $2 billion and $10 billion, and large cap for companies with a market cap greater than $10 billion. Also, growth or value funds, or a blend of both. Growth stock funds hold companies that are expected to grow at a rate faster than the overall stock market, such as tech stocks like Facebook or Google, and these generally have a higher price-to-earnings ratio, and are considered to be more aggressive investments as they have higher risk. Value stock funds hold companies that generate consistent earnings today, and generally have a lower price-to-earnings ratio. A key component for mutual funds is the expense ratio, or the annual fee associated with that fund. Actively managed funds are the funds with a team of experts or professionals picking the securities in the fund. They generally have an expense ratio of 1 to 2%. At 2%, for every $1,000 you're investing in an actively managed fund, you're paying the team of experts picking your securities $20. And at $10,000, you'll be paying them a $200 annual fee. Over time, that expense can eat away at your overall returns. The fee is also paid regardless of how well the experts pick the securities in your portfolio. So, if your portfolio underperforms and ends up losing money, you still end up paying that annual fee. That's what led to the popularity of index funds. Index funds are mutual funds, but not all mutual funds are index funds. Index funds have a significantly lower expense ratio, as is based on the belief that it is very hard and often very expensive to beat the market consistently. An index fund manager will buy stocks that correlate to a major index, such as the S&P 500 or or the Dow Jones Industrial Average. This strategy requires less research from advisors or experts, so there are less expenses. And because of that, index funds usually have an expense ratio less than 0.2%. An example of an index fund is the Charles Schwab 500 Index, the SWPPX, that has a gross expense ratio of just 0.02%, meaning for every $1,000 that you invest in this Charles Schwab 500 Index, you're only paying 20 cents as the annual fee, and for every $10,000 invested, you're only paying an annual fee of $2, which is significantly less expensive than actively managed funds. And research has shown that index funds beat 90% of all actively managed funds, so it's not only cheaper, but also better performing than the actively managed funds. Finally, we get to exchange-traded funds, or ETFs. ETFs have many similarities with mutual funds. Just as there is a wide variety of mutual funds, there is a wide variety of ETFs. ETFs have the added benefit of features similar to stocks. For example, ETFs can be bought and sold at any point throughout the trading day, versus most mutual funds are priced and traded at the end of the day. ETFs may have the same or lower fee than their corresponding mutual fund, and could require a lower dollar minimum amount to invest depending on the brokerage you are using. Most ETFs allow for dividend reinvestment, so you can set up your ETFs to buy more shares for you and make you more money. Also, most ETFs are not actively managed, so they result in lower expense ratios. Hope this video helped you understand what a mutual fund is and the differences between a mutual fund, an index fund, and ETF, and give you a better idea of what you would like to invest in. If you like this video, hit that like button, subscribe, and hit that notification bell. Feel free to leave any questions or comments you have below, and you guys have a good one.